125, it relates to provisions and events after the reporting period. We need to identify two adjusting events from these four. These events have happened in the month of April. The financial statement period is 31st March. So these things have happened after 31st March. So the first one is the customer went bankrupt after reporting date. Thomas Company, a customer of the company which owes the company 2 million at 31st March 15, entered insolvency on 3rd April 15. So they went bankrupt. They entered into insolvency after the reporting date, but the condition existed before the reporting date. So it is an um, adjusting event. Employee met with an accident after the reporting date here. An employee has commenced legal proceedings against Cambridge Company following industrial accident on 10th April. So the employee met with an accident on 10th April, and uh, the company is also expected to lose the case, and the estimated damage is 350. But all of this has happened after the reporting date, so it is not an adjusting event. Normal sales of inventory happened after the reporting date. So even if so inventory that was held at cost at 200,000 and it was sold on 21st April, financial statements have not yet issued. Although the reporting date is 31st March, but the transactions happened within 1 month later, and by that time the financial statements are not issued. So what has happened here is there is a sale of inventory. So inventory is stated at cost or net realizable value, whichever is less, lesser of the net realizable value and the cost. So because it was, we know now before issuing the statements only that it will be sold, or it has been sold at a lesser price, 150,000. So the inventory needs to be restated actually. So it is an adjusting event, even if it has happened after the reporting date, you know but the financial statements have not been issued, and the rule to state inventory is lower of the cost or net realizable value. So we now know that the net realizable value is 150,000. So the value of the inventory on the financial statements as on 31st March needs to be restated. So it is an adjusting event. So we now have the answer, but let's read fourth one also. There is a decision to sell some of the division took place before the reporting date. The company had agreed the sale of the Wordsworth division at a board meeting on 25th March 2015. The public announcement was made on 1st April. So even if the decision was made, this has not taken place. And also the communication was made after this period end, like after 31st, after 30th, after 31st March. On 1st April they made this announcement, and also this has not taken place before the reporting period. So this is not an adjusting event. So first and third should be our answer.